Number one, we've been told, when I went and started working at Morgan Stanley Deanwood the day before 9/11, even when I was in the Army, everybody would say, buy a Roth IRA and diversify. Okay? Diversification. That's a concept we've heard for a long time. Inflation increases gold. Whenever there's inflation, Peter Schiff, oh my gosh, gold's going to go because, we printed 40% of the US dollar has been printed in the last 18 months. Gold's going to go up. We didn't see that cause and effect. We didn't see the cause and effect with that taking place. What are your thoughts with some of these things where the traditional, conventional way of things have been questioned based on the last 18, 24 months?
Inflation and diversification are both bromides. There are these simplistic terms that people toss around, but no one really thinks very deeply about them in my experience. I mean, let's start with inflation. Inflation is not 2%. Inflation is not the CPI. It's not 7.5%. Inflation, properly understood, is simply the rate at which the price of anything appreciates in the currency, which is the frame of reference, which means that you can calculate an inflation rate for a Picasso painting, which is different than a building in New York, which is different than a bond, which is different than a market basket of goods and services that you wish to buy, which is different than the market basket of goods and services I want to sell you. So what's the real inflation rate? It's a vector, right? It's not a scalar. A scalar is like 2%. No, it's not. It's like an n-dimensional vector, and there's a different inflation rate for everything in every place for every time period, dynamically evolving, right? Once you understand that, you realize that there's probably two inflation rates of interest. One inflation rate is the rate at which cost of living is going up for a middle-class family. That's not the CPI, because the CPI is a manipulated market basket set by a politician or a bureaucrat that is engineered not to go up in price very fast. Most average people would find that their inflation rate is higher than the CPI. And if, for example, we don't include the cost of buying a home in the CPI, even though it stands to reason that just about any reasonable person would want to buy a house at some point in their life. So you can calculate a consumer inflation rate, which is different than CPI, but you can also calculate an asset inflation rate. That's the cost of getting rich or staying rich. If you want to be wealthy, it's not good enough to keep up with CPI. You have to actually keep up with the rate at which assets are appreciating, right? The cost of housing went up 18.8% year over year. That's Case-Shiller, according to the Case-Shiller index, right? That's another. That's a common asset. But if you look at the S&P index, which is a market basket of desirable companies, that gives you a surrogate for a monetary inflation rate. The monetary inflation rate's been running 7 to 10% a year in the U.S. at the same time that the CPI has been running 1%. If you understood that, you understand that your cost of capital is more like 10%, which meant that any investment you made that didn't yield 10% was making you poorer. You were losing wealth. Any business person understands that. I couldn't get you to accept a 2% ROI on an investment. So if you understand inflation's a vector, then you start to realize that the inflation rate in Miami Beach is different than it is in Kansas City. And you understand that the inflation rate, if you want to stay wealthy, is much higher. The inflation rate in 2020 was about 25% for assets. The inflation rate for bonds was at one point higher, right? You could have bought a bond for $1 million that yielded $50,000 in interest a decade ago. If you wanted Social Security, if you wanted $50,000 in income risk-free the rest of your life, the cost was $1 million. When the 10-year yield went to 50 basis points, you would have to pay $10 million for the same bond. The bond went up by a factor of 10. What's the inflation rate? Right? The inflation rate in that particular case was 100%. It was like hyperinflation. You had hyperinflation in the bond market. You had massive inflation in the asset market. You had no inflation in the Domino's pizza delivery, Netflix market for a while. And if what you want to do is live in your parents' basement and watch Netflix and order pizza, then the inflation rate much lower for you. And if you wanted to stay wealthy, or you wanted to get wealthy or hold shareholder value, inflation rate looks more like 30-40% in like 18 months. So once you understand inflation is a vector, then you stop paying attention to just one cherry-picked number, because what you realize is I can manufacture any inflation rate you want simply by adjusting the market basket of products and services.